This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the rapid broad market sell-off, key support levels for the S&P 500, technical signals suggesting a short-term bounce versus long-term recession risks, and an in-depth look at Bitcoin's crypto winter. Links and resources are in the description below. If you find this podcast helpful, please consider subscribing and help us reach our first 1,000 subscribers as we build a research-informed investing community. So, imagine logging into your brokerage account right now and watching, the cash equivalent of a luxury car just vanish.
Yeah, just completely gone.
Exactly, just vanishing into thin air over the course of maybe 6 weeks. That is the visceral reality for a lot of everyday investors tuning into this deep dive.
Oh, absolutely. It's terrifying.
Right. And looking at the SPY, the ETF tracking the S&P 500, it's plummeted from a high of 697 all the way down to 647.
Yeah.
It has been this relentless, aggressive slide. So our mission today is to strip away that emotional panic. We really want to separate the temporary daily volatility from the actual structural trends so you can navigate this environment based on mechanics, not fear.
Yeah, and stripping away the emotion is basically the only way to survive a tape that is moving this fast. When you see a sea of red candles day after day, human psychology just naturally defaults to a state of panic.
Sure, it's fight or flight.
Exactly. But to navigate this, we have to look past those flashing red numbers and, understand the underlying mechanical forces that are forcing prices down to these specific support levels.
Yeah.
Like we recently hit a major, highly anticipated technical floor right around the 645 to 650 zone on the SPY.
And it is definitely not isolated to the broader indices either. The tech-heavy ETFs have absorbed a massive amount of the damage. They're dropping roughly 10% just over the last month. And we know a major catalyst here is the sudden escalation of geopolitical conflicts that are just dominating the news cycle. But if we pull back the curtain on the actual order books, we're seeing a massive spike in capitulation volume.
Right, and capitulation volume is basically the secret engine of institutional accumulation. When everyday retail investors look at those massive volume spikes on down days, they just see an absolute catastrophe,
Like everyone is just stampeding for the exits.
Yeah, hitting the sell button at the exact same time because the evening news is terrifying. But Wall Street views that exact same event as a rare, highly lucrative logistical opportunity.
I think the mechanics of that are fascinating because it comes down to pure market plumbing. Like if a massive institutional fund wants to deploy $2 billion into a stock, they physically cannot do that on a calm, quiet Tuesday.
No, absolutely not.
Right, because if they try to buy that many shares when no one is really selling, their own massive buy orders will instantly drive the price of the stock through the roof. They end up ruining their own entry price.
Yeah, they price themselves out of the market.
Exactly. They essentially need a burning building. They need retail investors to panic and dump millions of shares so the institution can quietly vacuum up all that inventory without moving the ticker upward against themselves.
That is the structural reality of liquidity. They require your panic to fill their massive orders. That high volume of selling provides the exact cover they need to accumulate assets at a steep discount.
Which logically suggests that if the biggest players in the market are stepping in to absorb all this selling pressure, the free fall has to hit the brakes eventually, right? Like the selling supply gets exhausted because it's just being eaten up by institutional demand.
Yeah, and we are already seeing the technical evidence of that exhaustion. The extreme oversold indicators are currently stretched to their absolute mathematical limits.
Wow, really?
Yeah, a great way to visualize this is by looking at volatility envelopes. So they track how far a price has deviated from its historical average. Think of a stock's price like a dog on a retractable leash, with the average price being the owner walking the dog.
Okay, so the dog can wander a bit to the left or right, but eventually it hits the absolute end of that physical leash.
Exactly. And when it hits the end of the leash, physics and momentum demand that the dog gets yanked back toward the center. Recently, the price action completely broke through the bottom edge of those volatility envelopes.
Meaning that the leash is fully maxed out.
Right. Historically, when the market stretches the leash that far, you almost always trigger an immediate mechanical reaction. It sets the stage for what we call a short-term relief rally or a dead cat bounce, simply because the relentless selling pressure has temporarily burned itself out.
So we might see a few green days, the leash yanks back, and everyone on social media starts celebrating that the danger has passed and we are heading straight back to all-time highs.
Yeah, but that's a trap.
Because a short-term snapback doesn't fix a broken foundation.
I mean, if we zoom out from these daily charts and look at the broader macroeconomic weather system, a much more concerning picture starts to emerge, doesn't it? It really does. The daily bounces are just short-term noise masking a larger structural shift.
Yeah.
We're seeing major warning signs flashing on the long-term indicators, specifically the monthly oscillators.
Oh, okay, the monthly ones.
Yeah, these tools measure the deeply rooted momentum of the market. Unlike daily charts that react to a single news headline, monthly signals move like massive cargo ships.
They take a long time to turn.
Exactly. They take miles to turn around, and the warning signals they are flashing right now could take several months to fully play out in the real economy.
So what exactly are those cargo ships telling us? If the short-term leash is snapping back, but the long-term momentum is dragging us down, how does that translate to the actual economy?
Well, they are pointing directly toward the downstream effects of these ongoing geopolitical conflicts, and the primary transmission mechanism here is oil.
Ah, of course, oil.
Right. When global conflicts drag on, supply chains are threatened, and oil prices naturally surge. Sustained high energy costs operate like a hidden tax on the entire global economy. It costs companies significantly more to manufacture goods, package them, ship them. Those corporate profit margins get squeezed really tight.
And companies just pass those costs down to the consumer, which sparks inflation, forcing consumers to cut back on discretionary spending.
Exactly.
So corporate earnings drop, and suddenly the market starts a slow, agonizing stair-step decline. We aren't just looking at a quick dip here. We could be looking at a multi-month drift down to much lower targets, potentially in the 611 range on the SPY, or in a severe recessionary environment, all the way down to 560.
Yeah, that 560 level is where things get really painful.
But let's contextualize that 611 target for a second, though.
Yeah.
Dropping from 697 to 611 is roughly a 12% pullback. In the grand scheme of the stock market, a 12% drop is essentially a standard valuation reset. It just flushes out the excess leverage. So why are we throwing around the heavy recession word for what looks like a routine market stress test?
Because a 12% drop in a stable macroeconomic environment is entirely healthy. But we are not operating in a stable environment right now.
Right.
We are pricing in the very real threat of compounding global tensions and sticky inflation. The market is not dropping simply because valuations were slightly too high. It's dropping because the fundamental catalysts driving global commerce are shrouded in chaos.
And institutional capital absolutely despises chaos. I mean, you can build a financial model for a bad earnings report. You can put high interest rates into a spreadsheet.
You can quantify it.
Exactly. But you cannot put unpredictable geopolitical conflict into a spreadsheet. The lack of certainty is what drives the massive sell-offs.
But that leads us to one of the most counterintuitive yet crucial psychological patterns in financial history. Markets do not wait for the chaos to end before they recover.
Wait, really? They don't?
No, they almost always bottom out when the chaos is still actively raging. There is a deeply ingrained historical rule on Wall Street. You buy on bombs and sell on trumpets.
Buy on bombs and sell on trumpets, meaning you buy when the initial panic hits and you sell when the victory parade is happening.
Exactly. When a crisis first erupts, when the proverbial first bombs drop, uncertainty peaks. Nobody knows how bad the fallout will be, so the market aggressively prices in the worst-case scenario.
Right.
But as the conflict drags out over months, even if the daily headlines remain incredibly grim, the actual uncertainty begins to fade. The market learns how to measure and quantify the bad news. So the definitive market bottom usually occurs much closer to the terrifying start of a crisis than the celebratory resolution at the end.
So if you wait for the skies to completely clear before you buy your umbrella, the storm is over and the umbrellas are already marked back up to full price.
That's a great way to put it.
You have to be willing to deploy capital while the headlines are still actively screaming at you.
Yeah, if you demand absolute certainty, you will mathematically miss the bottom every single time.
Okay, so if institutional panic and uncertainty dictate the movements of the S&P 500, we need to look at what happens in a market where that panic is magnified tenfold. And that brings us to the ultimate barometer of retail and institutional risk, Bitcoin and the broader cryptocurrency market.
Oh, yeah. The crypto market operates as a high beta version of traditional equities. When the stock market catches a cold, crypto catches pneumonia.
Catches pneumonia, right.
And right now, the technical charts confirm that Bitcoin has officially entered a crypto winter.
Now, crypto winter sounds really dramatic, like something out of a fantasy novel where guys in tech fleece stare sadly at their plummeting portfolios.
Yeah.
But mechanically, what actually defines a winter phase versus just a really bad month?
It is defined by a rigid structural shift in price action. So a bull market builds a staircase going up higher highs and higher lows. A crypto winter builds a definitive staircase going down.
Okay.
Every time Bitcoin attempts to rally and break out, the sellers overwhelm the buyers at a lower price point than the previous attempt. It establishes a relentless pattern of lower highs and lower lows.
The buyers just systematically lose their ammunition, and the asset gets heavily rejected at those key weekly moving averages.
Exactly. And if we look at the historical data from previous market cycles, these downward structural movements, which are often called legs down, operate with surprising mathematical consistency.
How consistent are we talking?
They typically measure between 36 and 38%. If that exact historical percentage plays out again from the current rejection levels, it projects a downside target range for Bitcoin landing between $49,000 and $57,000.
So we are looking at a staircase stepping down into the $50,000 range. But is there a silver lining here? Because inside all that structural weakness, the underlying momentum indicators are telling a completely different story, aren't they?
They really are. They're currently hitting historic lows, scraping levels we haven't seen since the absolute macroeconomic bottoms of 2015, 2018, and 2022.
Wow.
This creates one of the most powerful technical setups in investing.
Yeah.
Bullish divergence.
Mm-hmm.
To understand this, you have to separate the actual price of the asset from the momentum driving it.
Okay, separate price and momentum.
Right. A bullish divergence happens when the physical price of Bitcoin makes one more agonizing leg down, hitting a brand new lower low.
Yeah.
But the momentum indicator, which measures the underlying speed and intense pressure of the selling, actually shifts upward, creating a higher low.
I see. So it's exactly like a car rolling backward down a steep hill. The car is still physically moving backward. That represents the price dropping to a new low. But the driver is finally slamming their foot on the brakes. The actual momentum of that backward slide is rapidly decelerating, even though the car hasn't completely stopped moving in reverse yet.
That's spot on. The selling pressure is mathematically exhausting itself. The visual price looks terrifying, but under the hood, the engine driving the crash is running completely out of gas.
Right.
When a bullish divergence prints on a massive, long-term weekly chart, historical data strongly suggests it is the ultimate transition point.
Right.
It marks the death of the bear market and the silent foundational beginning of the next major bull run.
So the pain might not be technically over, but the underlying mechanics are signaling that the end is actively forming right now. That actually brings us to the most practical, actionable part of this deep dive. If broad equities are sliding down a macroeconomic stairstep and major cryptos are breaking hard in the middle of a winter, where do you actually put your capital?
Right, because we cannot just sit entirely in cash while inflation eats away at it, but stepping blindly into a volatile market is how you catch a falling knife. The core strategy in a tape like this is identifying relative strength. Even when the broader indices are bleeding out, capital always rotates somewhere. There are always isolated pockets of assets that just refuse to drop.
And the source material highlighted a brilliant example of this with the altcoin Tau. While the rest of the cryptocurrency market is getting absolutely hammered, Tau is hovering around $269.
Yeah.
It is displaying massive relative strength, meaning it is actively holding its ground and defending its value while its peers are collapsing.
And relative strength proves that the buyers have deep conviction. I mean, they are refusing to sell even when the macroeconomic headlines are giving them every excuse to panic.
And it isn't just treading water either. Tau is printing a highly specific bullish technical formation known as an inverse head and shoulders.
Which is a huge signal.
Right. If you imagine a chart, it looks like three distinct dips. The middle dip pushes the lowest, that's the head, and the two dips on either side are slightly shallower, forming the shoulders. Psychologically, this is a visual representation of a battlefield where the sellers are running out of ammo over three distinct waves.
Yeah, they push the price down to form the left shoulder, but buyers step in. Then they launch a massive offensive to drive the price to a new absolute low, the head, but the buyers violently reject it.
Right.
Finally, the sellers try one last weak push to form the right shoulder, and the buyers completely overrun them. It proves the selling pressure is dead, signaling a powerful trend reversal toward higher highs.
Identifying an asset like Tau with relative strength is crucial, but execution is what actually protects your portfolio. I mean, the mechanics of how you deploy your cash matter just as much as what you are buying.
Definitely. In a headline-driven, highly volatile environment, the absolute worst thing you can do is dump your entire cash reserve into the market on a single Tuesday because you think you spotted the absolute bottom.
Yeah, that's a recipe for disaster.
The mathematical advantage belongs to dollar cost averaging, or DCA, combined with strategic cash tranches.
Let's walk through the actual math of why that works. Say you have $10,000 sitting in cash. You don't deploy all 10,000. You deploy a small tranche, maybe just $2,500 to establish a position.
Right. You deploy that first quarter to ensure you have skin in the game if the market suddenly rips upward. But you retain 75% of your cash specifically to exploit the macroeconomic chaos we discussed earlier.
Oh, to weaponize the chaos.
Exactly. Imagine you go all in on a Friday afternoon. Over the weekend, a major geopolitical conflict escalates. On Monday morning, the market gaps down 20%.
Yeah.
If you went all in, you are trapped in a massive, unrealized loss, entirely paralyzed.
But if you held that cash in reserve, that Monday morning gap down is no longer a crisis. It is a mechanical advantage. You take your next $2,500 tranche and buy the exact same asset at a 20% discount. Because the price is lower, your money buys significantly more shares than it did on Friday. This aggressively drags your average cost basis down. You mathematically engineer a scenario where you require a much smaller bounce to return to profitability.
You are utilizing the exact same liquidity mechanics the institutional whales use. You are weaponizing retail panic to accumulate assets at a lower cost basis while retaining the flexibility to survive the volatility.
That is such a powerful shift in perspective.
Many investors are thinking through what this means for their own positioning. If this raised a question or perspective for you, feel free to share it in the comments.
Yeah, the community insight is invaluable right now. So let's distill all of these complex mechanics down into 4 definitive takeaways you can immediately apply to your strategy. First, the broad markets have hit major technical support. The extreme stretching of volatility envelopes makes a short-term relief rally highly probable, but do not mistake a technical snapback for safety. The long-term macroeconomic risks are still steering the ship. Second, the current downward pressure is heavily tied to geopolitical uncertainty and the downstream margin squeeze of rising oil prices. Keep the bombs and trumpets rule in mind. Historically, the market will price in the worst-case scenario and bottom out long before the actual chaos is resolved. Third, Bitcoin is structurally locked in a crypto winter with a historical downside target in the $50,000 range. However, a massive bullish divergence is forming on the long-term charts, signaling that the momentum driving the sell-off is actively running out of gas.
A huge setup.
Exactly. And finally, protect your portfolio by hunting for relative strength and deploying capital in strategic tranches. Keeping heavy cash reserves allows you to weaponize weekend gap downs, mathematically lowering your cost basis instead of being trapped by volatility.
Those are the underlying mechanics driving the current tape. I want to leave you with one final thought to analyze as you review your own positions. We have established that markets collapse on uncertainty and rise on certainty. So ask yourself, what specific piece of certain news are you waiting for before you feel safe deploying your capital? And if you wait until that certainty is printed on the front page of the newspaper, will you have already mathematically missed the bottom?
Thanks for listening to the 15-Minute Investor.